So gold just had its worst two-week collapse since 1983. Bombs are falling in the Middle East. Oil is above $100. And gold, the asset that is supposed to protect you from exactly this, is down nearly 20% from its all-time high. I want you to sit with that for a second, because if you don't understand why that is happening, you are going to make the wrong decision next. And in a market moving this fast, the wrong decision costs more than the crash itself. Here is what I've learned after 40 years of watching markets behave in ways that seem to break their own rules. Gold is not broken. The rule most investors think governs gold is broken. And understanding the difference between those two things is the most important financial insight you can have right now. But the real story isn't why gold fell. The real story is what this crash reveals about the system underneath gold, and why Ray Dalio says the investors who understand that system are not panicking right now. They are preparing, because what happens after a crash like this, in the specific monetary configuration we are in today, has a very clear historical pattern. And that pattern does not end where most people think it ends. What I've observed in 40 years of navigating debt cycles and monetary transitions, including this exact scenario: dollar up, yields up, war ongoing, gold falling, is something every person who owns gold, silver, or any precious metals exposure needs to hear before they make a single move. Subscribe now. Here is exactly what happened and what actually drives gold when the rules seem to stop working. Let me start with what I call the mechanism problem. Most investors have a simple mental model of gold. War happens, fear rises, gold goes up. It's in the handbook. Gold didn't read the handbook this time. Gold hit an all-time high of $5,589 per ounce on January 28, 2026. As of March 19th, it is trading as low as $4,551. That is a drop of roughly 18.5% in less than 2 months, and it is still moving lower. The sell-off has now stretched to 7 consecutive sessions, the longest losing streak since 2023. And during those 7 sessions, Iran's Revolutionary Guard closed the Strait of Hormuz. Oil hit $100 per barrel. Bombs fell on Thran. The Middle East entered its most serious military escalation since 1973, and gold fell every single day. So either everything you believed about gold as a safe haven is wrong, or there is a mechanism operating underneath this market that most investors have never been taught to see. And I've been watching that mechanism operate for 40 years. Here is how it works. Here's where things get important. The number you need to understand is not the gold price. The number you need to understand is 4.25. That is the current yield on the U.S. 10-year Treasury bond as of March 19, 2026. And that single number explains more about why gold is falling during a war than any analysis of the war itself. Here is the mechanism step by step. The Federal Reserve held rates steady on March 18th, but more importantly revised its 2026 inflation forecast higher to 2.7%. Chair Jerome Powell explicitly flagged energy price spillover from the Iran war driving oil above $100 as justification for maintaining a restrictive policy stance. When the Fed says higher for longer, bond yields rise. The dollar and benchmark 10-year U.S. Treasury yields rose, making gold more expensive for holders of other currencies and diminishing the appeal of the non-yielding metal. Now here is the part that almost nobody explains clearly. Gold produces no income, no interest, no dividend. It just sits there and holds its value over time. When Treasury bonds pay 4.25%, 25% annually with zero default risk because they are backed by the U.S. government, investors face a real choice: hold gold that pays nothing or hold treasuries that pay 4.25%. When that yield is low, say 1% or 2%, gold wins easily. The inflation, protection, and store of value more than compensate. But when yields hit 4.25%, 25%, and the dollar strengthens simultaneously, the math of holding gold becomes genuinely painful. You are paying an opportunity cost of 4.25% per year to own an asset that just fell 18%. That is the mechanism, not the war, not the bombs. The war actually made gold's situation worse because the war drove oil above $100, which drove inflation fears, which drove the Fed hawkish, which drove yields to 4.25%, which drove gold down. The war didn't save gold. The war is the reason gold is falling. And this is where the real story begins, because there is a second mechanism operating simultaneously. And this one is the one that explains the specific violence of this particular crash. I call it the leverage unwind. And it is the mechanism that turns a correction into a crash in hours. For months, market participants had priced in at least 3 rate cuts for 2026, betting that cooling inflation and moderating GDP growth would give policymakers the green light to ease. The shift in the median projection for year-end 2026 to 3.4%, up from 2.9% in December 2025, sent a clear message. The Fed is in no rush. Throughout 2025 and early 2026, retail investors poured over $70 billion into gold ETFs. A significant portion of that money was in leveraged products, 2x and 3x ETFs that multiply the daily move. These products have a design feature that most investors discover only when it costs them money. They rebalance daily. When gold falls, the leveraged ETF must sell. Lower prices trigger more selling. More selling creates lower prices. The cycle accelerates until the leveraged position is fully liquidated, which can happen in a single session. This is not speculation. Gold initially spiked from $5,296 to $5,423 on the Hormuz news, then reversed hard, down more than 6% from the intraday high. Paper traders flushing positions. Nothing more fundamental than that. The very products that helped retail investors ride gold to $5,589 became the mechanism that crashed it back to $4,551 in 2 weeks. The retail investor was not selling because they changed their mind about gold. They were selling because the product they owned gave them no other option. And while retail was forced to sell, something else was happening simultaneously on the other side of the world. Layer 1, the sovereign selling nobody is discussing. In 1983, gold suffered one of its worst weekly declines in decades. The reason was not a financial crisis or a bank blow-up. It was Middle Eastern oil-producing states selling gold to raise cash because their oil revenue had collapsed. The OPEC market share had been destroyed by North Sea oil, Alaskan production, and new fields in Brazil and Malaysia, Saudi Arabia, Qatar, Kuwait. They needed cash to defend their dollar currency pegs and fund their governments. They sold gold, and that selling flooded the market and triggered a crash. Mechanism in 2026 is the same, inverted. In 1983, Gulf states couldn't get a high enough oil price because supply was too high. In 2026, oil prices are at $100, but Gulf states can't physically ship their oil because the Strait of Hormuz is closed. Storage is full. Saudi Arabia and Kuwait have already begun cutting production because they have nowhere to put the oil they're pumping. Revenue has collapsed, not because the price is low, but because the pathway is blocked. Gold and silver prices have been on a roller coaster ride in the past few days. After racking up huge gains over the past year to hit record highs, prices of the precious metals fell sharply. The same governments that built gold reserves for exactly this rainy day are now experiencing exactly this rainy day. And they are doing exactly what they did in 1983. They are selling gold to raise the dollars they need to defend their currency pegs and fund their governments while their oil revenue is temporarily disrupted. Saudi Arabia holds 323 tons of gold. Qatar holds 115 tons. Kuwait holds 79 tons. These are not small positions, and they don't need to sell all of it to move the market. They need to sell enough to cover the cash flow gap created by a Strait of Hormuz closure that nobody anticipated would last this long. Layer 2, the algorithm amplification. Hedge fund algorithms do not care about geopolitics. They care about two numbers, the dollar index and the 10-year Treasury yield. When the dollar rises above 99, the algorithm sells gold. When the 10-year yield rises above 4%, the algorithm sells gold. The 10-year Treasury yield jumped to 4.2%. The dollar index climbed toward 99.9, and gold, a non-yielding asset whose entire bull thesis rested on falling real yields and a weakening dollar, repriced accordingly. Billions of dollars in paper gold contracts were sold automatically, not because any human decided the gold thesis was broken, because the preset conditions for selling were triggered simultaneously across hundreds of algorithmic trading systems. Layer 3, the paper versus physical divergence, the signal that matters most. Here is what I find most important about this crash, and what I have watched in every major gold correction in 40 years. The paper market and the physical market are telling different stories. Meanwhile, physical gold premiums stayed elevated. Demand from stackers, jewelers, and institutional buyers held steady. The physical market, where actual metal changes hands, told a completely different story than the futures screen. Asian central banks are buying. Chinese institutional investors are buying. Physical gold is leaving COMEX vaults at an elevated rate, the same drainage pattern that was visible before the January all-time high. The paper price crashed. The physical demand did not. When I have observed this divergence in my career, paper selling hard while physical demand holds, it has historically marked not the end of a bull market, but a transfer of ownership from leveraged retail positions to unleveraged institutional and sovereign buyers who are comfortable waiting. What I've learned over 40 years is that gold does not move on a single variable. It moves on the relationship between several variables simultaneously. And when those variables align against it in the short term, the correction can be violent, fast, and confusing to anyone who only watches the headline price. The three variables that drive gold in the short term are the real yield on the 10-year Treasury, the dollar index, and the level of leverage positioning in the futures and ETF markets. All three aligned against gold simultaneously on March 18th and 19th. The Fed hawkish hold raised real yields. The dollar strengthened in response, and the leveraged retail positions built up during the $70 billion ETF inflow of 2025 were forced liquidated by the daily rebalancing mechanism. That is the short-term price. It is real, it is painful, and it is temporary. The long-term price is set by a completely different set of variables. The debt cycle, the credibility of the monetary system, the pace of central bank gold accumulation, the fiscal arithmetic of a government carrying $36.2 trillion in debt and paying $1.03 trillion annually in interest, the first time in American history that interest payments exceeded the defense budget. The structural case for gold has not collapsed. Central banks have been buying at elevated levels for 3 consecutive years. J.P. Morgan is maintaining its year-end 2026 price target of $6,300 per ounce. Deutsche Bank stands behind $6,000. Neither bank has moved those targets despite the recent correction. Both see the current pullback as a tactical event inside a structural bull market driven by temporary macro pressures rather than a change in the underlying demand picture. Here is what I watch. Not the war, not the daily. Price. 2 numbers. Number 1, the DXY, the dollar index. The dollar index climbed toward 99.9. When the DXY is above 100, gold faces a strong mechanical headwind. When it falls back below 97, which happens when the market begins pricing Fed rate cuts again, that headwind reverses. Watch the DXY. It tells you more about the short-term direction of gold than any geopolitical event. Number 2, the 10-year Treasury yield. With the 10-year Treasury yield hitting 4.25%, 25% the opportunity cost of holding gold has spiked, leading to a massive liquidation of long positions. When that yield drops below 3.5%, which happens when recession fears override inflation fears, or when the Fed is forced to cut, the opportunity cost of holding gold collapses and the mechanical selling reverses. Watch the yield, not the price of gold. The yield tells you when the short-term mechanism is turning. And here is what I know about those 2 numbers in the current configuration. If the 4.25% yield on the 10-year Treasury begins to significantly increase the government's interest expense, a forced pivot or some form of yield curve control could become a reality by 2027. Such a scenario would likely serve as the ultimate catalyst for gold and silver to reclaim their recent losses and move toward the $5,000 and $100 marks, respectively. The United States is rolling over $9.2 trillion in debt this fiscal year. At 4.25%, that debt costs $391 billion more annually than it cost at 2% rates. The arithmetic of sustaining 4.25%, 25% rates against a $36.2 trillion debt load is not indefinitely maintainable. The moment that arithmetic forces a policy response, a rate cut, a form of yield curve control, a return to quantitative easing under whatever name the next Fed chair chooses, the mechanical headwind against gold reverses. And when it reverses against the backdrop of a structural bull market, with central banks buying 863 tons per year, the reversal will be fast, violent, and will recover this correction and more. In 1983, gold fell sharply. Then it entered a multi-year consolidation. The investors who sold at the bottom of that crash and waited for confirmation of the reversal before re-entering missed the entirety of the next bull market. The investors who understood that the 1983 crash was a sovereign cash flow event, not a structural change in gold's monetary role, accumulated patiently and held through the noise. I am not telling you what to do with your money. I do not know your situation, your time horizon, or your risk tolerance. What I am telling you is what I know from watching this specific configuration play out before. And what I know is this. The crash happened in the paper market. The physical market held. The institutional price targets held. The central bank demand held. The structural conditions that drove gold from $2,600 to $5,589. The debt cycle, the de-dollarization trend, the fiscal arithmetic of the American government did not change on. March 18th, the dot plot changed. The short-term price changed. The structure did not. In a world where almost every financial activity incorporates credit risk, that of a state, a central bank, an intermediary, gold remains the only asset without a counterparty. It makes no promises, pays no interest, and is not dependent on political decisions. It simply exists, and that is precisely why it provides security. That statement is as true at $4,551 as it was at $5,589. The price changed. The property did not. The market scorecard from the week of March 17th to March 21st confirms the mechanism I described with precision. Spot gold prices retreated toward $4,657 an ounce, a sharp reversal from the record highs seen earlier this year. Silver faced even more aggressive selling pressure, tumbling toward the $73 mark. The dual pressure of a surging U.S. dollar index and 10-year Treasury yields climbing to 4.25% stripped away the luster from non-yielding assets. The Spider Gold Shares ETF GLD and the iShares Silver Trust SLV gapped lower on high volume Thursday morning. The selling was broad, retail and institutional, forced and discretionary. The paper market spoke with one voice this week, and that voice said, "Ye are up, dollar is up, sell." The physical market spoke differently. Physical gold premiums stayed elevated. Demand from stackers, jewelers, and institutional buyers held steady. The Shanghai Gold Exchange continued trading at a premium to the COMEX paper price. Asian central banks continued their purchasing programs without interruption. The divergence between what the paper market was doing and what the physical market was doing was as wide this week as at any point in the current bull market. J.P. Morgan's $6,300 target unchanged. Deutsche Bank's $6,000 target unchanged. J.P. Morgan analysts said they expected gold to reach $6,300 an ounce, a 30% gain from current prices by the end of 2026. The institutions that set those targets had access to the same FOMC decision, the same dot plot revision, the same oil shock data that every retail investor was reacting to on Thursday. They looked at all of it and did not move their targets. That is the signal I watch, not what the institutions say in their press releases, what they do with their price targets when the short-term price moves against them. One type of investor watched gold fall 18% during a war and concluded the gold thesis is broken. They sold. They locked in losses. They will watch the recovery, which J.P. Morgan and Deutsche Bank are both still projecting, to levels 30% above current prices from the sidelines. Not because they were wrong about gold, because they mistook the short-term mechanical price for the structural price, because they owned leveraged products that were designed to force them out on exactly the kind of volatility that corrections in bull markets produce. The other type of investor understands the two markets. The paper market, which crashed because yields rose. The dollar strengthened. Leveraged positions were liquidated, and Gulf sovereign wealth funds sold gold to cover oil revenue shortfalls. The exact 1983 playbook run by the exact same players for the exact same reason. and the physical market, which held because the property that makes gold valuable. No counterparty risk, no issuer, no promise that can be broken did not change when the Fed revised its dot plot. This was not a gold story. It was not a war story.